I've been investing in registered education savings plans for over 10 years now and have made lots of mistakes, largely by making things more complicated than they needed to be. So this video will go through how to very simply invest for your kids' education. Now, the goal of this video is not to give a detailed explanation of all the nuances of registered education savings plans, but I need to go through some of the key pieces to highlight the simple parts of my plan. So why should you open a family registered education savings plan? There's really just a few key reasons. One is you're going to get a 20% Canadian education savings grant and up to $500 per child per year. So you only get the 20% grant on the first $2,500 that you contribute. So that free 20% is certainly well worth taking and will really help grow your kids' education plan. Secondly, the money gets to grow tax-free. There will have to be tax paid at the end, but you'll likely get 15, 18 years of tax-free growth, which is certainly well worth it. And then that growth is eventually taxed in the hands of the student, not the parent. So I think these are in order of the big benefits. Now, I encourage people to open a family plan. Even if you've had just one child, you can open a family plan and then add future kids to that plan as you have more. So there are no current annual limits, but there is a $50,000 limit over the life of the plan per kid that you should be aware of. So if you have a family plan with 3 children since 2017, 50 each, so $150,000 is the most that you could contribute in the plan. So again, this isn't a limit for the whole plan, it's a limit per kid in the plan. You do only get the grants on the first $2,500. If you've missed some years, you can sort of back contribute $2,500 extra up to $5,000 in 1 year to catch up if you have sufficient past room. Kind of no matter what income bracket you're in, the lifetime Canadian education savings grant that you're going to be able to get is $7,200. So this is a chart from Canada.ca. I don't want to go through the nuances, but it really doesn't matter what income bracket you're in. You're looking at getting a maximum of a little over $7,000. You may be able to get a Canadian Learner's Bond or grant, potentially if your income is lower, but I'm not going to address that. I'm just going to use the numbers you can see for all income brackets. So before I talk about the plan, where exactly are we trying to go with this? So you can only get the grant on the first $2,500. So if you contribute $2,500 per year, you'll get the max $500 grant per year up until when you hit the $7,200 max around year 15. And then I've sort of run 2 models, whether you're getting 4% or 6%. So you're looking at about doubling your money. You're going to put in about $45,000 over 18 years. If you put $2,500 in per year, you'll end up with about $90,000 at 6% and a little less than that at 4%. Okay, so you're hopefully going to have somewhere between $75,000 and $100,000, regardless of what percentage return you get. So how can we sort of grow our money from that 45 to 75 to 100 as easily as possible? Okay, so what do you need to get started before you can even invest? You're going to need a social insurance number for your child, but that's pretty easy today. All that mountain of paperwork that you get when your child is born at the hospital will likely include signing up for a SIN number. And then the larger work will be opening a self-directed registered education savings plan at the institution of your choice. We want to keep things simple, so I'm going to talk about Questrade that I use. Or if you have accounts at your current bank, RBC, Scotiabank, you may want to just stay there, even if you're going to pay slightly more fees. Simplicity is the main goal here. Okay. Once you have that SIN number and you've got that account open, what are you going to have to do on a regular basis? You want to set up, ideally, a monthly contribution. Okay? Now, you're not going to get a grant above $2,500 per year. So that would set sort of a high-end cap of $208.33 that you'd want to contribute per month. You could set up that bill payment through your bank, and that's what I do. So I use Scotiabank for my regular checking banking, and I just have a bill pay. So under bill payments, I search for Questrade, and then I had to know my account number, and the bill number is the account number. You can also set this up within your RESP account to do a automatic withdrawal from a checking account. I like to keep control, so I want to have full control over the bill payment to stop it, pause it, do whatever I want. Okay. Once you're contributing money and you've made an investment, you're going to want to set up, or I encourage you to set up, a dividend reinvestment plan. This is part of the simplicity that any dividends you get are going to be automatically reinvested over the lifetime of the plan. And then I would plan to reinvest your contributions between 2 and 4 times per year. So maybe every quarter or twice a year, reinvest the money. So what exactly are you going to invest the money in? Just before I get there, part of why I pick Questrade or things to watch out for with your bank is fees. So with Questrade and most institutions, you're not going to have to pay anything to open a RESP account. And then what really varies from bank to bank is how low a balance can you have and not pay a yearly fee. Questrade has kind of always been free if you've had over $1,000. Typically, you would pay a fee under $1,000. Since the pandemic, they've dropped that fee, but I wouldn't count on that staying. But with Questrade, you can have a fairly low balance and not pay any yearly fees. Commissions with Questrade, and this is why I really like my simple RESP investing with Questrade, is I just use a ETF, and I can buy ETFs for free, or you could buy an exchange traded fund for free of Questrade. So you could be slowly investing over 18 or 20 years and pay absolutely no commission. It's only when you go to start selling things off that you'd have to start paying a commission. Now it's only $5 per trade, so maybe you've done well and you've accumulated $100,000, and every year over 4 or 5 years you sell $20,000 in one chunk. So if you sold 20, one chunk a year, $5 in fees a year, very, very low cost. So you always have these two fees. What's going to be your yearly fee and what's going to be your commissions to buy and sell. Questrade is as low as you can get. Something like Scotia iTrade, which I don't personally use, but some of the retirement money that I manage for other people is done through Scotia iTrade. Their RESP fees are, if you have under $15,000, you're going to pay $25 per year. So that's certainly going to take you a while to get up to $15,000 in an RESP. You're not going to want to contribute that amount right away because you're not going to get the grant on the full amount. There's that $2,500 per year cap. So just this would be what you'd want to watch out for. Scotia iTrade, for most people, are going to be paying $10 per trade. That's not going to be a big deal, but it's certainly going to start adding up. So if you're reinvesting 4 times a year, $40 for your 4 trades plus $25 for your under $15,000 account. Again, this can sort of really add into your returns when you only have a few $1,000s at the beginning. So hopefully you can decide whether you want to go with Questrade, another online broker, or your bank to set up your registered education savings plan. Part of my plan is to just stay with Canadian stocks. I've made some mistakes trying to be more complicated, bought some American dividend payers early in my RESP investing days, and I sort of didn't realize that the US does not recognize RESPs as tax-deferred or registered accounts. So you're going to have to pay withholding tax on U.S. dividends. So I would just personally recommend staying away from U.S. dividend payers. You'd get more diversification, but you're just going to add more headache and loss of income. Okay. So my sort of simple investing suggestions are keep your RESP investing plan really simple. Stick to exchange traded funds, or ideally just use one very diversified dividend ETF paying fund. I'd recommend you stay very dividend focused, or I'm 100% dividend focused. That's going to be less volatile. You're still going to be paid regular dividends during the downturn. And if you have a big crash or something like COVID, you're not going to have as much volatility as if you're into NASDAQ stocks or things that are more risky. The sort of $1 million plus portfolio that I manage for people in retirement is all dividend paying companies, and they were down 4% for the year 2022. So I'm not saying this would always be the case, but much less volatile than the NASDAQ. So invest in ETFs, make them dividend focused, and just reinvest those dividends over the RESP lifetime. So the bottom, reinvesting the dividends, for Scotia iTrade, it's really simple. They just have a little checkbox next to your investments, and you can check that and reinvest the dividends. Questrade isn't nearly as simple. So if you're with Questrade, you have to download a dividend purchase plan authorization form. So you've got the exact name here highlighted or underlined in red. You'd have to fill in your account number for your RESP. Again, every individual account would have its own number. So don't look for an overall account, don't look for your Questrade account. You're looking for your individual RESP account. And then I would just check off you want all securities. Even if you only just have one ETF, I would just check off for all securities. And you're going to sign it, date it, and scan it and send it in. At least you can upload this form. You don't have to mail it. But again, Scotia iTrade and other brokers make this a lot easier. They would probably use the term DRIP. Again, Questrade doesn't use DRIP. It's this dividend purchase authorization plan form. So what do I do to keep it simple and kind of follow those steps? I just use ZDV. So this is a BMO Canadian dividend ETF. It currently pays a 4% yield. So every $100 you have invested in it over the year, you'll get $4.40. BMO has to make some profit off this, so I pay a management expense ratio of about 0.4% per year. And I don't pay that directly, it just comes out of my returns. You may not even realize you're paying it. Now, the dividends currently right now are part of the distribution of 7 cents per month. Most of the distribution is dividends that are paid out. So currently in my family RESP, which is split between 2 different children, I've 2,200-ish shares. Now, I've only purchased 2,100 of those shares. Every month, ZDV pays that 7 cents I mentioned, which is $155 a month right now. And that is enough cash to buy 8 full shares. So because I've filled out that dividend purchase plan authorization form, my broker, Questrade, will automatically take this $155, buy the max amount of full shares they can, which happens to be 8. Any leftover money just sits in my account as cash. And the next month I'd go from 2216 to 2224 shares. Okay? And then the next month I'm going to gain another 8 shares. And that share account will just keep constantly compounding, and those extra shares will lead to more dividends. Now, there's no commissions on the dividend reinvestment plan, so that's really nice. So I'm buying more shares with cash for free, and I'm getting my dividends reinvested for free. So one ETF, nice and simple. Everything's being reinvested, fairly low volatility. Now, as for performance, over the last 10 years, a pretty good time frame to look back. It's averaged about 7%, so even greater than that 6% I used in my model. So at this rate of return, $45,000 of contribution can easily turn into over $100,000 over 18 years. If you look back through COVID, it's actually done a little better than average, which might seem ironic or unexpected, almost 9% return, which would include the dip of the great financial crisis. But the dip isn't the problem, or didn't cause any problems, because since the dip, it's more than gone above where it was pre-dip. Now the number I would look at is since inception, it's been a little over 7%. So again, more than happy with this. So what is ZDV invested in? What are you buying? You're basically buying the largest Canadian dividend payers in Canada, and BMO is going to decide exactly how to weight them. Now, this is Canada, so you're going to have a lot of resources, oil, minerals, and particularly financials, both the banks and the telcos. So we see Enbridge as the number one investment as of late 2022, and then lots of banks, a bit of telco, more resources, more energy. Now, the number one is energy, but that is a pipeline, so it's going to have a much more stable revenue than a straight up oil company, which, CNQ would be kind of more in that category. So you are not as diversified as you would be as if you owned an ETF with investments over the whole world, but again, you're not having to worry about withholding tax that you're not going to get back in a registered education savings plan. So it's not viewed the same as a retirement plan. Now, there are some other good options. Both a Vanguard option, VDV, has a low management expense ratio and pretty similar type of investments. Another one, XEI, is fairly energy heavy. It's done very well lately, but I'd probably stay away from it. But if you really like the energy sector, that's another option. So these two ETFs that I just mentioned, the Vanguard one, again, fairly similar to the BMO one. Again, it's got a lower management expense ratio. So if I was starting today, I'd probably pick this one. I'm not going to switch everything over just to save 0.1% in fees. The XEI, the iShare one, again, 0.22% management expense ratio. Done really well. I was kind of curious why it had done really well in doing the research for this video, and it's all this energy and materials. I probably, in a registered education savings plan, wouldn't want to have all this energy exposure. So again, ZDV or the Vanguard would be, two really good simple choices. I wouldn't get complicated in picking half of one and half of another. That's getting away from the simplicity, which is the goal of this video and this plan. So to summarize everything, you can really invest in your kids' education really simply. The most work is just filling out the paperwork online to get the account open. You're likely going to get that SIN card in the mail because you signed up for it at the hospital when your child was born. I wouldn't open an individual plan. I would open a family plan as soon as your first child is born. Set up that automatic payment into it. I wouldn't pay more than about $208 per month per child, unless you're behind a couple years and want to catch up. I would just purchase one of those two sort of ETFs mentioned that are diversified, set up a dividend reinvestment plan, and pick a couple times a year to reinvest the new contributions. So if you're putting in $208 per month, maybe you've got a couple kids, so a little over $400 a month. Halfway through the year, you've got a few $1,000s, so maybe twice a year on Canada Day and Christmas, you go in and just buy the most whole number of shares you can of whatever ETF you've picked. So once things are set up, it's maybe a twice a year type of thing that you go in to check on. So hopefully you found this video interesting. You can open a plan, a registered education savings plan with some confidence, knowing it doesn't have to be very complicated. You should be able to get a pretty decent rate of return and be all set up for your kid to go to school. Now, what's not part of this video is selling stocks and taking the money out. The only comment I'll make there is I would start removing the money that your child needs probably 2 years before they need it. So if they're going to school when they're 18, by the time they're 16, look at how much capital they need for that first year or how much you intend to take out of the plan and sell that. And the easiest thing is just leave it in cash. Don't try to be fancy. But don't realize you don't have to sell everything in the plan when they're 16 if they're still going to be taking some money out when they're 21 or 22. But again, I'd use at least a 2-year window of taking money out. So hopefully you enjoyed this video. Please consider liking it and subscribing to the channel if this information was beneficial for you.